The Fed decided to raise interest rates. What does it mean for you? Hello, everyone, and welcome back to another episode at Novarise Invest, your channel for financial education. So today we're going to talk about the rate. I am sure I'm not the first one to announce this. I know the decision to raise the rates had been announced a couple of days ago, but as you know, I like to give it some time to see what else is happening in the market, what else the officials are announcing, so that way I could present to you a full-blown picture of what's going on. So in today's video, what we're going to do is to understand the economical landscape. What are the rates today and how does that impact everything going forward? And towards the end of the video, I'm going to share a couple of things that needs to be on your radar so you know what to be on the lookout for in the event that some of these events do take place. So without further ado, let's just jump straight into the screen. Before we start, let me remind you to subscribe to the channel and hit the notifications button. All right, so we have this article right here from the Wall Street Journal, and where the headline is saying that the Fed is raising interest rates for the first time since 2018. So what are some of the things that you should pay attention to in this article? So the Fed is raising its benchmark federal funds rate by a quarter percentage point to a range between 0.25 and 0.5% for the first time since 2018. Even in the prospects of rising rates, remember to keep things into perspective. These rates are still very, very low compared to the rates that we have back in the 80s or the 90s. And here's an illustration to show you what I mean. So this is where we're standing somewhere today in 2022. And look at what happened back in the 80s and the 90s. Again, it's definitely not news for those who are trying to secure a car loan or to secure a mortgage. Yes, the rates are going up, but once again, when we keep things into perspective, things aren't as bad as it might seem. Now, back to the article. As we are scrolling down, I want to make a call out to this section right here. So at the time, right, most Fed officials indicated they didn't anticipate a need to raise interest rates above 3% over the next few years. But who knows? Things might change given the situation that's happening between Ukraine and Russia, which are having a tremendous impact, not just in the US, but also around the world. So the Fed fund rate, for those who don't know, every time you hear about the Fed raising interest rates, they always make a mention of the Fed fund rate. So here's the definition of what it is for those who don't know. The Fed fund rate, it's an overnight rate of lending between banks, and that influences other consumer and business borrowing costs throughout the economy, including rates on mortgages, credit cards, saving accounts, car loans, and corporate debt. Raising rates typically restrains spending, while cutting rates encourages such borrowing. So if we have to refer back to what has been happening in the last couple of years, what the definition is referring to actually can be portrayed in real life. So at the beginning of the pandemic, what did the Fed do? They decided to lower rates. And what did people start doing? They started refinancing their homes because they want to lock in the lower rate. Consumption started picking up. Debt became cheaper, and everybody wanted to borrow or wanted to have access to cheap money. So that's in essence what they're referring to. But now that the rates are increasing, they're having a different impact in our spending, because the more expensive the debt is, the least likely you are to go out and borrow money or to want to get into debt, just because you're going to have to pay higher interest. And that's what this article is about. So back to the screen. When we flip this article into a separate one that talks about the impact of the rates for you, this is what I'm referring to. So there are multiple categories where the increase in rates can impact you. But in this episode, we're going to narrow it down to the ones that are present in this article. So it's going to affect your mortgages, right? Because mortgage prices are set largely based on the yield of the 10-year U.S. government bond, also known as the Treasury note. And this rate is used as a benchmark for all different types of loans, including mortgages. So as the Fed signaled higher rates, the 10-year yield has moved higher, and this has in turn pushed the average rate of a 30-year fixed mortgage to over 4% for the first time since 2019. A year ago, it was only 3.05% according to Freddie Mac. And as we keep scrolling down, basically what I mentioned before is actually stated here in writing. Over the past 2 years, low rates and low inventory have fueled a white-hot housing market, which we all were witnesses of, and that skyrocketed home values, leading to fierce bidding wars. And as of January, the median home sales price of a single family home stood at $357,100, and that's up nearly 16% year over year, according to the National Associations of Realtors. And once again, just like I mentioned, the prospect of higher rates have begun, and that it's leading to a reduction of financing demand and rising mortgage rates, what will likely create even more difficulty for those who are hunting for homes, right? So that's on the mortgage side. Now, how does it affect your savings, right? For those who are big savers, for those who have a high yield savings accounts or certificate of deposits, according to what this article say, the change is basically null, right? Because as of today, banks have very little incentive to raise interest on savings accounts, right? And I'm sure you've heard over the last few years of the saying, savers are losers, right? And that in fact has a lot to do with the interest, not because savers are loser, but you are really losing money when you're putting your money in the bank, gaining no interest whatsoever, especially if you're in the middle of a high inflationary rate. Because according to the article, what you see here, the interest rates offered on savings accounts and many certificate of deposits are offering an annual percentage yield of 0.14%. Goldman Sachs, on the other hand, is offering a 0.50%, and online banks like Ally are also offering 0.50%. So when you compare 0.14%, 0.50% and 0.50% on your savings, right? That's how much your money is growing. And that all of a sudden it's eroded by inflation. It's made disappear because, as you know, January, the inflation rate was 7.5, and according to this chart, the inflation in February closed at 7.9%. So in reality, there's actually no incentive whatsoever for you to put money in your savings. So that has been what's going on with your savings accounts over the past couple of years. However, as interest rate goes up, right, your CDs or your saving accounts could go up. However, don't bet on making millions of dollars or making high returns on your savings account because the rates are still near historical lows. Okay, now moving down, another way the rates could impact you, it's an auto loan, right? Especially today, where not only you have to deal with soaring car prices, whether you're buying brand new or whether you're buying used cars, you also have to deal with the high cost of gasoline, which are off the roof, right? And I actually found this chart right here that shows the cost of gas in all 50 states. So I'm currently in New York, and in New York, the rate for 1 gallon of regular gas, it's set at $4.36. Okay, that is ridiculous. I feel really bad for those who have to pump gas. So coming back to this article, remember once again, make sure you do the math on the financing, because right now you don't have to worry just about the financing. You also have to worry about the rising cost of pretty much everything else going on around you. Call it gas, call it the rates, right? And according to Bankrate, the average rate on a 5-year new car loan was 3.98. So it's going up and up, right? But again, depending on how you look at it, I still don't consider this to be that bad, because I remember my first car loan many years ago came at a whooping 6.5%. That was the rate. So I will take 3.98 over anything. But still, this is not good news if you could have had a rate of like 2 point something, right? So now moving along, and let's talk about credit cards. But before we do that, if you're enjoying this episode, do not forget to hit the like button right here so you can help this episode rank and help others like you looking for information of this kind. Well, if mortgages and car loans are going up because of the rates, credit cards shouldn't get a pass, right? So for those who have racked up a lot of debt, a lot of credit card debt, now it is a good time, especially now, to start paying down your credit card debt if you have the money available. If not, feel free to just simply leverage an offer of a 0% credit card and do a balance transfer. For those who have no idea what I'm talking about, here's an episode that I created not too long ago that you could definitely check out and learn ways to reduce that debt before those rate increases hit your credit card account. Okay. And last but not least, student loans. They don't get a pass either. So for those who were quote unquote lucky enough to lock down the rates for 2021 to 2022, you are off the hook because your loan, assuming it's a public loan, your loan rate has been set. However, every May, the interest rate for federal student loan is set according to the 10-year Treasury note auction. And these rates are fixed for the entire life of the loan. And the rate today for direct subsidized and unsubsidized undergraduate loan is currently set at 3.73% until June 2022, according to the U.S. Department of Education. However, next year, the rate increase could impact loans distributed for the following academic year because the Fed is raising interest rates, right? Now, things are a little bit different for those who are in the private education because private education loans could be affected by the rise in rates right away. Private students' loan either charge fixed rates, which stay consistent, or variable rates, which can increase or decrease depending on the institution you borrow from or your individual financial circumstances. So now, what can you expect next? So according to this article, the Fed will consider more aggressive interest rate increases to reduce inflation. And I know we've heard about this over and over again. What happened right now in March is just the beginning, but there are expectations that there are going to be at least 6 more increases throughout the year. And as you scroll down through the article, the facts stay the same, just like we read at the beginning. So the target is to raise the rates below 2% at the end of this year in 2022 and raise it to 2.75 sometime next year in 2023. So as of today, everyone is paying attention to everything that's happening in the conflict between Ukraine and Russia, and which, like I said in the beginning, has had a tremendous impact, not just in the US, but also around the world. And based on what's happening and based on how the nation unfolds, they're going to continue to monitor what's happening in the market and make decisions based off what they see it's happening in the market. And that is exactly what this quote it's saying. If we conclude that it is appropriate to move more aggressively by raising the federal funds rate by more than 1/4 percentage point at meetings, we will do so, Mr. Powell said. And if we determine that we need to tighten beyond common measures of neutral and into more restrictive stance, we would do that as well. So there you have it. All we have left is to continue to monitor and see what's going on in the market. And of course, as soon as we find that in Novarise, we're definitely going to create an episode just to keep you informed and to share actionable items that you can implement so that you can protect your net worth and the money that you work so hard for. And since I have you here, let me invite you to check this episode right here on the side that's going to help you complement everything you just learned today. See you in the next video. Take care. Bye-bye.